Hello everyone and welcome back to the world of finance. Friends, in this class we are continuing with the first part of capital budgeting, and this is the fourth lecture on capital budgeting part 1. In this class we are going to discuss something very important, and that is about reinvestment assumptions under capital budgeting. Very important discussion. More than the calculations, it is the concept that is very important. Please carefully understand this whole thing. So we have seen in all the earlier classes that once you make an initial investment in the project, then the project starts generating returns in the form of cash flows for you, and you will be continually receiving these cash flows. You have learned how to compute NPV, IRR, all these calculations. But one thing that you should now understand: what happens to the money obtained from those cash flows? Where does that money go? The point is, when we are receiving any cash flow from any project, we are not going to keep that money idle. So assumption number 1 over here is the amount is immediately reinvested. The question now arises, if you are receiving cash flows, you only tell me, are you going to keep the money idle or are you going to reinvest that money? The answer is obviously we need not keep the money idle, we should reinvest that money. And now if we are anyway reinvesting that money, at what rate should we reinvest? The rate at which we should reinvest it is the same rate which is our expected rate of return. For example, if we have a project from which we are expecting 10% returns. Why are we expecting 10% returns? Because the opportunity cost of capital is 10%. Now what is this opportunity cost of capital? Suppose prevailing rate of return in the market is 10%, means wherever I invest my money, I am going to earn 10% interest. So if I am investing that same money in this particular project, my money is not coming free of cost. My money gets involved with an opportunity cost of capital. In other words, if I am investing my money in this project, I am sacrificing that opportunity to invest it elsewhere at 10% rate. So same 10% I would expect from this project also. So that 10% which is my expected rate of return from this project is actually an opportunity cost of capital. So the point is very clear. The moment this project starts giving me cash flows, I would invest that cash flow at that same rate. That is again a very important assumption. First thing, all the cash flows received from the project are to be reinvested. Second assumption, these cash flows will be reinvested at the same rate which is the discounting rate or the expected rate of return. Now when these cash flows are reinvested, obviously these will accumulate to a future value. For example, suppose a project has life of 5 years and each year it is generating cash flows. Because the project life is 5 years, we would want to see how much money we can accumulate by end of 5 years from this project. If we accumulate all the cash flows by reinvesting, how would we do that? Project life is 5 years, 1, 2, 3, 4, 5, and assume that each year the project is giving you 1 lakh of cash flow. So when I say year 1, 2, 3, 4, 5, we actually mean end of each year, correct? Because when you are arriving at end of that particular year, that is the time when you get the complete cash flow of that year. So if you have obtained cash flow of rupees 1 lakh by end of year 1, project life being 5 years, from end of year 1 till end of year 5, that is for 4 years, you are going to reinvest that cash flow at the same rate which is your expected rate of return. Suppose it is 10% per annum. So what we would do, 1 lakh obtained from that project's cash flow in first year will be reinvested for 4 years at 10% per annum rate. Thereafter, in the second year again we would get the cash flow. So from end of second year till end of fifth year, the gap is now 3 years. The second year cash flow will be reinvested for 3 years, but at which rate? same rate of return, that is 10%. So you are reinvesting all your cash flows for the remaining period till end of project's life, and you would want to find what would be the cumulative value. Now, a wonderful thing that you should understand, that these cash flows, when they are accumulated in the future value, that is at end of 5th year, if you find the present value of that future value, or you find the present value of cash flows from the project directly, both the present values would match. And that is what we are going to understand. So we will take a couple of examples and we will try to mathematically first of all prove one thing, that without reinvesting your cash flow, the NPV that you are talking about, the net present value from the project that you are talking about, is never going to happen. That means when you are finding NPV from a project, NPV itself is backed up with that assumption that each cash inflow gets reinvested at the same rate for the remaining period or for the remaining life of the project. And let us do one thing, let us take back to back a couple of examples for complete clear understanding about this whole concept. So under the heading reinvestment assumptions under capital budgeting, write up this example that I was talking about. Consider the following information with respect to cash flows from a project. Annual cash flows are given as rupees 1 lakh per annum. Rate of return is given as 10% per annum. Life of the project is given as 5 years. Determine the following: future value of cash flows at end of 5th year and present value of these cash flows. Now, computing present value of cash flow is nothing new for you. What is something important over here in this example is how to determine the future value of cash flows that will be accumulated by end of 5th year. However, with this computation of present value also involved over here, we are going to show some calculative evidences ahead. So carefully take note of how to compute the future values of cash flows that will be accumulated by end of 5th year. So the cash flows obtained in each year will be reinvested in the following manner. Now carefully look at this table, and as I have explained exactly, we are going to do the same. So cash flows will be recurring for 5 years as rupees 1 lakh each year, and the cash flow that you will obtain in the first year, that will be reinvested for the remaining period. So when I say cash flows obtained in year 1, we always consider that as end of year 1. So from end of year 1 to end of year 5, the gap is 4 years. So the first cash flow will be reinvested for 4 years. Similarly, second cash flow will be reinvested for 3 years. When you come to third year end, same logic. Third year end, again what you are getting, rupees 1 lakh as cash flow. From end of third year to end of 5th year, the period of reinvestment of this cash flow will be 2 years. Mind it, I have told you, we are not going to keep a single rupee of cash flow as idle amount. We are going to reinvest as soon as we obtain these cash flows. Now, 4th year cash flow will be reinvested for 1 year, and 5th year cash flow, which is already at end of 5th year, will not be reinvested. So you may just either write nothing in that line, or you may write that as 0 year. 0 year means that amount is actually not reinvested at all. Now what you do is, you find the future value of each of these cash flows. So first cash flow will be reinvested for 4 years, and its future value will be 1 lakh into 1.1 raised to 4. Likewise, the second cash flow, which will be reinvested for 3 years, will have its future value as 1 lakh into 1.1 raised to 3. Likewise, the other one, 1 lakh into 1.1 raised to 2, then 1 lakh into 1.1 raised to 1. And the last line, because the cash flow is not being reinvested, don't write any working over there. The future value of that cash flow will remain 1 lakh itself. Now let us just do the computation part, and what we get is 146,410, 1,33,100, 121,000, and then 1,10,000, and the last one remains 1 lakh as it is. When you take the aggregate of all these values, it will be the cumulative amount of cash flow that will be accumulated by end of 5 years, assuming that these obtained cash flows are reinvested for the remaining period, and these are reinvested at expected rate of return of 10% per annum. So the cumulative value of cash flow which is obtained in future, that is at end of 5th year, will be 6,10,510. Now we have to make the calculation of the present value of all these cash flows. So now what you can do is, because each year cash flow is a uniform amount of cash flow, that is rupees 1 lakh, you can directly apply the annuity factor for determining the present values. So let us do that. Present value of annuity of rupee 1 lakh per annum for 5 years will be obtained when you multiply 1 lakh to the annuity factor of 3.790787, and what you get is 3,79,079. This will be the present value of these cash flows arising each year for 5 years. Now, if we try to find the present value of that cumulative future amount which we obtained in the previous working, that was 6,10,510. Suppose this is a lump sum amount of cash flow which is receivable after 5 years. That means a single cumulative amount, if that is receivable after 5 years, what would be its present value? Obviously, 6,10,510 will be divided by 1.1 raised to 5, and you will be surprised to know that the present value would still be the same what was the present value of each cash flow of rupee 1 lakh. So can't we conclude one very important thing over here, that if you are receiving cash flow of rupees 1 lakh each year for 5 years, or you get a lump sum amount of 6,10,510 at end of 5th year, both of these cash flows will be same because their present values are same. So this is proven mathematically. You may just write that implication. It is implied that annuity of rupees 1 lakh per annum for 5 years is equivalent to a lump sum cash flow of rupees 6,10,510 receivable after 5 years. Now one important thing, there is yet a shortcut way of determining the future value of cash flows, but that can be used only and only when the cash flows are uniform each year as given in this case, because it will be concept of future value of an annuity. So future value of an annuity can be determined by this formula, 1 plus I raised to n minus 1 divided by I. I stands for the interest rate which is 0.1 over here, that is 10%. N stands for the number of years. So it is 1 plus 0.1 raised to 5, that is 1.1 raised to 5 minus 1 divided by 0.1. It will eventually give you the same annuity factor, that is 6.1051, and when you multiply this annuity factor to cash flow of rupees 1 lakh each year, what you will get directly is the cumulative future value by end of 5th year. So you can always apply this future value of annuity formula and compute this annuity factor and multiply to the annual cash flows to arrive at future value of an annuity. But I told you this can be done only and only when the cash flows each year are uniform. Now what you can do is, you can conclude one more thing, that if someone is giving you 6,10,510 at end of 5th year, or if someone is giving you 1 lakh each year for 5 years, that is at end of each year, and if someone giving you the lump sum present value of 3,79,079 today, all these amounts would stand equivalent. Now let me explain you something that is very important over here. Can you notice one thing, that in this example, when you are obtaining cash flows of rupees 1 lakh each year, you have reinvested each of these cash flows for the remaining part of the project life. So cash flow obtained in first year was reinvested for 4 years, cash flow obtained in second year was reinvested for 3 years, and so on. You have accumulated a lump sum value by end of the project life. When you compute the present value of that lump sum amount, that will match with the present value of those annuity, that is cash flow of 1 lakh each year for 5 years, if you directly take the present value, both the present values are matching. That is why we conclude that you receive 1 lakh each year, or you receive a lump sum amount of 6,10,510 at end of 5th year, both are at par, both are one and the same, both are equivalent. That means when you are receiving that 1 lakh, and if you don't reinvest that money, if you do not reinvest that money, then 1 lakh will remain 1 lakh. So what will happen by end of the project life? Your total money in hand will be just 5 lakhs. By end of project life, if you have just got 5 lakhs and not 6,10,510, when you take the present value of that 5 lakhs, it will never match with that present value which you have obtained over here. That means the calculation of present value itself is backed by an assumption of reinvestment. If you do not make reinvestment, that present value or NPV calculation is never going to work. Now what we will do is, we will take one more example to understand this thing much better, and then we will have very, very important conclusions that we will draw from that example. Now, in order to better understand the reinvestment assumptions, let us consider one more example, and that would be example number 2. X Limited expects a rate of return of 10% per annum. It is willing to invest rupees 30,000 at present for a time horizon of 3 years. It has two different alternatives. Alternative number 1, invest rupees 30,000 for a block period of 3 years and receive a lump sum maturity value at end of 3rd year. And second alternative is invest rupees 30,000 in a project with life of 3 years that provides cash flow of 11,000, 12,100 and 13,310 in year 1, year 2 and year 3 respectively. So based on the above given information, determine the following. Number 1, maturity value of investment as per alternative 1, maturity value of investment as per alternative 2, that is future value of project cash flows if all cash flows are reinvested at discounting rate of 10% per annum, and present value of future cash flows from the project as per alternative 2 and the resulting NPV. Provide your analysis out of the above calculations. Let us move ahead and now start showing up the calculations. So determining future value of investment as per alternative 1. So don't forget what was your alternative 1. You have invested 30,000 for 3 years and your expected rate of return over here is 10% per annum. So obviously with 30,000 invested, your interest income for the first year will be 10% of 30,000, that is 3,000, and the cumulative value by end of first year will be 33,000. Then you will add 10% interest on 33,000, that is 3,300, and the cumulative value by end of second year would be 36,300. This 36,300 stays invested during the 3rd year. So 3rd year your interest income will be 10% of 36,300, that is 3630, and the maturity value at the 3rd year end will be 39,930. Now one thing is for sure, that we are simply applying the compounding effect. Now because it is simply a compounding effect, you can directly apply the compounding value formula and arrive at the future value of a single cash flow. So it is very simple. You can just determine it this way. Future value will be present value into 1 plus I raised to n, that will be 30,000 into 1.1 raised to 3, and what you get at the end is the same value, that is 39,930. Now let us move ahead and do the bigger task, that will be the future value of cash flows, that is the cash flows which are obtained from the project. If we keep on reinvesting these cash flows at 10% per annum, what would be the accumulated future value? Let us see how to make that calculation. Determining future value of cash flows from project if all cash flows are reinvested at discounting rate of 10%. So you begin with the cash flow that you have obtained in the first year, which is 11,000. Because it is cash flow obtained at end of first year, it will be reinvested for 2 years. Anyway, on this cash flow, you are not going to receive any interest in the first year because this is already at end of first year. So you will receive interest on this at second year. So during the second year, you will be earning interest of 10% on 11,000, that will be 1,100. And during the second year, you will also receive the cash flow of second year, which is 12,100. So the cumulative amount that you get by end of second year would be rupees 24,200. Now this amount stays invested for the third year, and third year you are going to earn 10% interest on 24,200, which will be 2,420. And then to this you are going to add the cash flow that you have obtained at the end of third year, which will be 13,310. The cumulative value simply comes to 39,930. So we find that the future value of these cash flows are matching with the future value of the alternative one also. Now one important thing, if you don't want to present your working this way, I have already explained you how to present this type of calculations. Unfortunately, the cash flows over here are not uniform, so you cannot apply future value of annuity formula. However, you can still make a shorter table the way we have seen in the earlier example. Let me show you that version of calculation as well. So you can say alternatively the future value can be determined as below. So each year's cash flow will be reinvested for the remaining period. So cash flow that you obtain in year 1 will be reinvested for 2 years. Cash flow that you obtain in second year will be reinvested for 1 year, and so on. So it will be 11,000 into 1.1 raised to 2, 12,100 into 1.1 raised to 1, and the third year cash flow remains as it is. So the future values that are getting accumulated by end of third year will be 13,310, 13,310 and 13,310, which is summing up to that same amount, that is 39,930. Now one last thing that is further asked in the question is to find the present value of the project cash flows and the resulting NPV. So that's a simple task for you, you know how to do it. So you just plot a table, record the cash flows of each year from the project, that is 11,000, 12,100 and 13,310. PV factors at 10% will be multiplied to these annual cash flows to obtain the present value of these cash flows, and the present value of these cash flows are summing up to exactly 30,000, and the initial investment in the project is also 30,000. That results into NPV as 0. 0 NPV clearly indicates that the project's rate of return is exactly what you expect, that is 10% per annum. In other words, IRR of the project will be 10%. Let us write up some conclusive points that we have identified, and then I offer you some more analytical explanation. So the conclusion that you should write over here, the future value of investment under both the alternatives is same. Therefore, X Limited is indifferent in terms of selection of one of the two investment alternatives. It can be concluded that rupees 30,000 invested as per alternative 1 will be equivalent to rupees 30,000 invested as per alternative 2, and basically because the project's IRR is also found to be exactly 10%. Now let me discuss some more analytical points over here with respect to the reinvestment. Now few things that we have understood by far. Whenever you are investing into a project, your investment is generally made at initial stage, and the project would start giving you cash flows thereafter. Year after year you will be receiving these cash flows. The question is, what would you do with that money? I told you at the early part of the class, you have just two choices, either keep that money idle or reinvest that money. The obvious choice would be to reinvest that money. Nobody would want to keep their money idle. If you reinvest the money, the next question that is very obvious is, at what rate of return would you reinvest? The answer to that question is, it will be your usual discounting rate always. Why? Because your discounting rate, as I have explained earlier, is the opportunity cost of capital. For example, if prevailing rate of return in the market is 10%, then everyone is capable of earning 10% returns. In that case, if I am investing, even I am capable of earning 10% rate of return. That 10% becomes my opportunity cost of capital for this project, because had I not invested my money into this project, I would have invested that money elsewhere earning 10%. Because I am sacrificing that opportunity and investing in this project, I would want this project also to provide rate of return of 10% to me. So what did we notice in this example? This example conveys two different investment proposals, alternative 1 and alternative 2. In alternative 1, you have invested 30,000 lump sum amount flat for 3 years at annual compounding rate of 10% per annum, and you get a lump sum maturity value of 39,930 by end of 3 years. Other alternative was to invest it into a project. That same 30,000 could have been invested into a project which gives you some different amount of cash flows. These cash flows will not be obtained as one lump sum amount, but it will be obtained on year to year basis, some amount at end of year 1, then end of year 2, then end of year 3. So what we are going to do to find the cumulative value by end of third year, cash flows obtained in year 1, that is by end of year 1, will be reinvested for 2 years. Cash flow obtained in second year will be reinvested for 1 year, and cash flow obtained by end of third year will be kept as it is. When you take aggregate of all these cumulative future values, it would match with the future value of that 30,000 which was invested flat at 10%. That itself is an indication that the project is giving you rate of return of 10%. But then when you computed the NPV of that project, NPV came to exactly 0 when you have applied a discounting rate of 10%. What does that mean? That project is giving you exactly 10% returns, and that is where we concluded that IRR of that project must be 10%. Now friends, in this example there wasn't any complication because IRR of the project and the discounting rate both were same. Now imagine that I get a project where its discounting rate is suppose same 10%. That means my discounting rate, my expected rate of return is still 10%, but that project is giving me high rate of return. Now my obtained cash flow, I cannot invest at that high rate of return in future because it was a singular opportunity. If I am not able to invest that money at a higher rate, my obvious investment rate, or I would say the obvious rate at which I would reinvest all my future cash inflows, will be the same original discounting rate. So for example, if a company has expected rate of return of 10% and it is analyzing a project, and the project is capable of generating substantially a higher rate of return, but that project involves a one-time investment. When you get cash flows from that project, you obviously are not going to keep that cash flow idle. You are going to reinvest that money, but that reinvestment will not happen at a higher rate. It will happen at your usual discounting rate. Now what happens? How do you compute IRR of a project? You try out different discounting rates. Suppose you apply 10% discounting rate and you find that the rate of return of that project is higher. How you get to know? Because at 10% discounting rate it gave you positive NPV. You try at 15%, suppose it still gives you a positive NPV, you apply 18% discounting rate and then you find that it is giving a negative NPV. Then you conclude that yes, somewhere between 15 and 18% you find IRR of the project. That means a project, when you are applying discounting rate of 15% and 18%, you are assuming that your money will get reinvested at 15% or 18% as the case may be, but your reinvestment will never happen at that rate. Your reinvestment will happen always at your original discounting rate. That is where we are going to talk about the errors in assumptions taken under IRR approach. But instead of talking just like that, it will be better if we take a calculative example in front of us for having much better understanding. Let us take up question number 20. Let us read this question. What is given over here? A project has life of 4 years. Annual cash inflows are rupees 3 lakhs per annum. Initial investment is rupees 8 lakhs. Determine NPV at discounting rate of 10% and IRR of this project and explain the reinvestment assumptions involved in your calculations. So what we will do is we'll first make the calculative part done, and then we will talk about these reinvestment assumptions that are involved over here. So let us move ahead and finish the calculative part. So determining NPV at discounting rate of 10%, which is informed to you. Because the cash flows are uniform over the life of the project, we are taking the annuity factor for 4 years at 10% discounting rate, which comes to 3.169865. Multiplying that with the annual cash flow of rupees 3 lakhs, what you get is total PV of inflow as 9,50,960. From that you subtract the cost of the project, and what you get is NPV of 1,50,960. Now for computing IRR, we would definitely take up little higher discounting rates, because at 10% discounting rate, the NPV was substantially positive. So we are considering 18% discounting rate for the first trial, and we take years 1 to 4. Annual cash flows are rupees 3 lakhs, and the annuity factor at 18% for 4 years comes to 2.690062. Multiplying 3 lakhs to that, what you get is 8,07,019. From that you subtract the initial investment or present value of cash outflow, and what you get is NPV, a positive NPV as 7019. So obviously the next trial we will be making at a little higher rate, that is 19%, and where we get the annuity factor as 2.638568, and the total PV of inflow comes to 7,91,576. That results into a negative NPV of 8424. So because at 18% you are getting a positive NPV and at 19% you are getting a negative NPV, it is implied that IRR must be between 18% and 19%. Let us move ahead and apply interpolation for determining IRR between 18% and 19%. I don't have to explain you these calculations. You have learned this very well in the earlier parts of the lectures. So when you compute this IRR, what you get is IRR equals to 18.45% approx. Now let us talk about those reinvestment assumptions. So every time we are dealing with NPV calculations, we are having reinvestment assumptions. Now obviously, if you could identify when you are determining IRR, what are you doing actually? Here what we did, we took 18% and 19% as two different discounting rates, and we have then found respective NPVs at those discounting rates, and then through interpolation we have determined an approximate IRR. But do you notice one thing? The moment you are taking discounting rate of 18%, by default your assumption is that your cash flows are getting reinvested at 18%. When you take discounting rate of 19%, by default you are assuming that your cash flows are getting reinvested at 19%. In simple words, whatever discounting rate that you apply for computing NPV, it is implied that same discounting rate is the rate at which you are reinvesting your cash flows. But what did we mention and learn from the beginning of this class? That all your monies can be reinvested not at any higher rate, but necessarily at the given discounting rate. So when you are computing NPV at 18% discounting rate, what is the assumption involved? That you are reinvesting your cash flows at 18% discounting rate, which is not going to work, because your original discounting rate, which is opportunity cost of capital, it is given as 10%. So maybe that project is giving you high rate of return, but if you are getting that money, you cannot reinvest back at that high rate. your reinvestment rate will be usual rate 10%. As a result, do you notice one thing? Because of that wrong assumption of reinvestment at a higher rate, the computed value of IRR itself has a small error, and that error is because of the wrong reinvestment assumption. So let me summarize one thing over here. When you are determining NPV, you are considering discounting rate, which is a realistic rate, which is your opportunity cost of capital. Now that discounting rate is the rate at which you would reinvest all your money. The moment you increase that discounting rate, by default you are assuming that you are reinvesting also at that higher rate. For computing IRR, what did we do? We have just increased the discounting rate for getting an approximate NPV closest to 0. And as a result, when you have increased the discounting rate, by default you are assuming that you are making your cash flows reinvested at such higher rate, which is not appropriate. So can you notice one thing? Two important capital budgeting techniques, NPV and IRR, they both have reinvestment assumptions. NPV method assumes that the reinvestments will be made at the usual discounting rate, and that happens to be a realistic assumption. IRR method assumes that these cash flows will be reinvested at IRR rate, which is a faulty assumption. So friends, because of that faulty assumption, the computed value of IRR itself could be misleading. Now, how to rectify this problem? How to overcome this problem of wrong IRR assumption? Here we have something called modified IRR. We have yet to discuss in details about how to determine modified IRR, but I will give you one simplest idea to understand how to determine modified IRR. What was the problem with IRR? Tell me. The problem with IRR was all your monies were getting reinvested at that IRR rate. That is the wrong assumption, right? So what we should do is all your investments should be made at your proper discounting rate. For example, if the applicable discounting rate to the company is 10%, first you reinvest all your cash flows at 10% and arrive at that lump sum future value, which we have been computing past couple of examples if you have noticed. So when you arrive at that lump sum future value, that future value you relate with the initial investment and identify a discounting rate that would match up the present value of that lump sum amount to its initial cost or to its present value, which is matching with initial cost. That discounting rate will not have a faulty assumption of reinvestment at IRR rate, because over there you are not reinvesting a single rupee. It's a lump sum value at maturity, which you are discounting at whatever be the most realistic rate. Here, because there is no reinvestment happening at any wrong rate, your calculation obviously go correct. That IRR which we arrive through this process is called modified IRR. So friends, I am right now just theoretically explaining you what is modified IRR. I'll give you steps to determine modified IRR, but believe me, just merely even noting down those steps will not work unless we step into some calculative examples. So concept supported with calculative examples can only clarify this whole matter. So once again, let me remind you what is happening over here. The reinvestment assumptions are there in capital budgeting. That is a fact. NPV method, IRR method, both are very, very important methods in capital budgeting. Both of these methods assume that all your cash flows which are obtained from the project will be reinvested. But what is the difference? NPV method assumes that these cash flows will be reinvested at the original discounting rate, and IRR method assumes that these cash inflows will be reinvested at IRR rate. Now you only decide which assumption is realistic and which assumption is unrealistic. So the conclusion is very clear. NPV assumptions are realistic, IRR assumptions are unrealistic. The moment you are making a calculation with an unrealistic assumption, it is implied that the calculation that you end up with will also not be appropriate. And that is why we have a need to modify this IRR. And logically, how would you modify this IRR? All your future cash flows at different points of time, don't directly take their present value, because the moment you take present value using a discounting rate, that reinvestment assumption at that discounting rate will come into picture. Therefore, instead of having multiple future amounts of cash inflows which you should discount at their present value, instead do one thing: the wrong assumption should not be kept wrong. In other words, the problem with IRR assumptions was what? All the cash flows are not to be reinvested at the IRR rate. So simply do one thing: all the future cash flows should be now reinvested at the original discounting rate, and you arrive at lump sum value in future. That lump sum value in future, you discount it back to its present value in such a way that the present value should match with the initial investment, and that IRR what you are computing, where reinvestment assumptions are not going wrong, that IRR is what we call as modified IRR. So friends, I told you that mentioning these steps just like that won't work. When we start solving questions, it will be much clearer. So just have patience. Let us first write these notes what we have discussed, and then what we do is we shall definitely take up calculative examples to understand this concept much better. So based on what we have just discussed, write under the heading the reinvestment assumptions involved in the above calculations. Number 1, with respect to NPV, it is assumed that cash flows are reinvested at discounting rate of 10% per annum, which is practically workable. That means NPV assumptions are definitely workable. With respect to IRR, it is assumed that all cash flows are reinvested at IRR rate of 18.45%, which is not practically workable. That means IRR assumptions are theoretical. It also signifies that the computed IRR will not be correct rate of return because it is based on investment assumptions that do not work in reality. Let us move ahead and continue writing further. The true IRR can be determined through modified IRR. You can also call it as MIRR. MIRR is the short form of modified IRR or modified internal rate of return. The process of determining MIRR is explained below. Now let me tell you one thing very clearly. The process that I am showing you over here involves 3 different steps, and I have not explained you this yet. I would just want you to note it down. Immediately after this, when we are taking up a calculative example, you will be getting complete clarity on the same. So please write up the process. Step 1, determine the future value of all cash inflows, assuming that such cash inflows are reinvested at the original discounting rate. Step 2, the future value obtained in step 1 should now be discounted to its present value in such a way that present value should match with initial investment. And you may just say in step 3 that if required, interpolation can be used for determining the appropriate discounting rates mentioned in step 2. So of course, if you are not getting 0 NPV, you may apply interpolation and you may just interpolate 2 different rates, one which we call as lower discounting rate and one that will be higher discounting rate. So if required, interpolation can be used for determining appropriate discounting rates mentioned in step 2. Such appropriate discounting rates will be considered as modified IRR.